If you think I am buying oil because I suddenly fell in love with commodities, you are already missing the point. I am not buying oil because I want drama. I am buying oil because I can see a shock moving through the system, and I know what high energy prices do to almost everything people casually call safe. That is the first truth. Most investors are comfortable talking about stocks, bonds, rates, inflation, and maybe gold. Oil makes them nervous because oil is not polite. Oil does not move in quiet little percentages that fit nicely into a retirement spreadsheet. Oil punches, it hits transportation, manufacturing, shipping, airlines, chemicals, food, consumer confidence, inflation expectations, interest rate policy, and eventually equity valuations. It hits so many layers of the economy that by the time the average investor feels it, the market is often already in a much uglier place than it was when the move began. That is why this matters, and that is the mother line of the whole story. I am not buying oil because I think oil is the future of my portfolio. I am buying oil because if this supply shock keeps widening, oil may become the thing that protects the rest of my portfolio from a much larger hit. That is a very different mindset. The uploaded reference document opens with a dramatic claim, and the drama is justified. We are not talking about a normal little fluctuation in global supply. We are talking about one of the most critical choke points in the world energy system being severely disrupted, while a large share of global exports depends on that same route. Still functioning, the Strait of Hormuz is not some niche shipping lane only oil specialists care about. It is one of the central arteries of the industrial world. When that artery tightens, the effects do not stay local, they spread everywhere. That is why I always begin here. If the artery matters, then the blockage matters more than most people think. Before the average person sees empty shelves or gets sticker shock at the pump, markets start asking an even more important question. If the flow remains constrained, what price is required to destroy enough demand to rebalance the system before real shortages become unavoidable? That is where the real oil move begins. Not at shortage, at the price required to prevent a worse shortage later. This is the first mechanism I want you to understand. I call it pre-shortage pricing. Most people think commodity spikes happen because the thing is already gone. That is not usually how major markets behave. Markets are forward-looking and deeply unpleasant in this respect. They do not wait for pain to become universal. They try to price the pain while there is still time for price itself to become part of the solution. If supply drops and demand does not adjust, the market raises the price until behavior changes, driving slows. Marginal consumption gets cut. Lower value uses begin disappearing. Businesses start rationing themselves. That is not morality. That is price doing emergency triage. And when the supply gap is as large as the one implied in the source material, price has to do much more than nudge. It has to hurt. The file argues that roughly 20 million barrels normally pass through the strait, that some fraction continues moving, but that perhaps 12 million barrels a day are effectively removed from normal flow. Whether the exact number floats slightly higher or lower day by day matters less to me than the order of magnitude if a double-digit share of global supply is disrupted around one critical bottleneck. This is not a normal trade. This is a structural shock, and structural shocks do not get fixed by headlines. They get fixed by reopened flows, alternative infrastructure, demand destruction, reserve drawdowns, or some combination of all four. That is the real framework. Now let us talk about why the market still seems less alarmed than the actual situation would suggest, because this is where many people get lulled into the wrong conclusion. They look at oil prices and say, if this were truly that bad, prices would already be at records. That sounds sensible. It is also incomplete. Prices do not need to go vertical immediately if inventories still exist as a temporary buffer. Inventories can make a structural problem look manageable right up until they start reaching levels that no longer reassure anybody. That is exactly why the inventory question matters so much. This is the second mechanism. I call it the buffer illusion. A market buffer is comforting until it starts shrinking fast enough that everyone realizes it is not a solution, only a delay. The source document makes this point forcefully. Yes, global inventories are large in the aggregate, but not all barrels are equally useful, equally mobile, equally timed, equally positioned, or equally ready for market. Some are strategic reserves held for emergencies, some are stuck in the wrong geography, some require specific refining capacity, some cannot be released quickly enough to patch a fast-moving disruption, and some of the total simply exists on paper as global stock rather than as instantly available economic relief. That distinction matters enormously. If the market begins the year with billions of barrels in total inventory, the average person hears safety, The serious investor asks a much narrower question. How many of those barrels are actually drawable, quickly usable, and relevant to the specific disruption we are facing? That is a much more sober number. And once you bring the number down from total stock to realistic buffer, the margin for error suddenly looks much thinner. That is where fear changes shape. This is why I do not dismiss the source document, emphasis on drawdown speed. 12 million barrels a day removed from ordinary flow is not simply a large number. It is a drain rate. Even if you debate the exact size, the concept is what matters. A market buffer can disappear in stages long before the official inventories hit zero. Panic begins when the market realizes the cushion is no longer thick enough to guarantee calm. No one waits for the last barrel. They react when the psychological comfort of the buffer breaks. That is when price can stop looking expensive and start looking insufficient. Now let me go one layer deeper. Oil shocks do not merely raise oil prices. They force every other asset to reprice around what higher energy does to growth, margins, inflation, and monetary policy. This is the part most people fail to connect. They think buying oil in a crisis is simply a bet on one commodity. In reality, a severe enough oil shock becomes a macro event, and once it becomes a macro event, it begins touching stocks everywhere, especially the optimistic parts of the market that depend on low inflation, easy financing, strong consumers, or stable growth assumptions. That is why I keep saying this is not just an oil idea. It is a portfolio defense idea. This is the third mechanism. I call it the cross-asset squeeze. High oil hits consumers by raising everyday costs. It hits companies by raising input costs. It hits transport-heavy sectors directly. It hits inflation expectations by reminding everyone that energy is still one of the fastest ways for price pressure to move through the entire economy. It hits central banks because they suddenly face a more painful problem, ease too much, and inflation may stay hotter, stay tight too long, and growth may crack harder. Either way, the market starts revaluing everything built on the assumption that inflation would remain controlled and oil would remain manageable. That is how one shock in one physical system leaks into the entire financial system, and that is why oil is such an unusual hedge. It is not protecting me against some abstract fear. It is protecting me against the very thing that can make a broad stock portfolio ugly in a hurry. Now, if I were a different kind of investor, I might respond by selling everything else. Sell the market. Raise cash, hide. Wait, but I have never found that style especially intelligent for my own temperament. I believe in long duration ownership of productive assets. I do not want to constantly abandon my positions every time the world becomes unstable. I want to keep my long-term exposure to equities, metals. I have the rest of my portfolio intact as much as possible, but I also do not need to behave naively while a clear shock is building. That is why I like this trade. This is the fourth mechanism. I call it asymmetric protection. If oil rises because the disruption persists, then the gains from oil may offset at least part of the damage elsewhere if the shock gets severe enough to create a real equity sell-off. I am not sitting there empty-handed watching everything bleed at once. I have something inside the portfolio that benefits from the exact force hurting the rest. And if that force gets resolved quickly, then yes, oil may retrace, but my broader portfolio likely does better in that outcome. Anyway, that means the hedge is serving a purpose even if it does not become a giant standalone home run. That is how I like to think. Not will this make the most money possible, but if I am wrong in one direction, does the rest of the portfolio breathe easier? That is good hedging. The source document says this directly in simpler language. The author is not trying to dump the S&P 500 gold, silver, and the rest in order to become some full-time oil speculator. He is using oil partly as protection against a broad stock market hit. I respect that instinct because it comes from system thinking. A stock-heavy portfolio is vulnerable to inflationary energy shocks. Owning something that can benefit from that same shock is a rational way to reduce the total pain. And if oil gains large enough while equities fall hard enough, then the trade becomes even more useful. The oil profits become dry powder. That matters because crashes are not only painful, they are opportunities if you still have functioning capital when they arrive. This is the fifth mechanism. I call it crash-funded defense. Most people experience market crashes defensively. They watch wealth evaporate and feel powerless. Their cash is too thin, their portfolio is bleeding, their confidence is weak, so the crash feels like pure suffering. But if one part of your book is rising because it was designed to benefit from the same event hurting the rest, Then the crash becomes something else. It becomes a transfer point. A profitable hedge can be harvested into cheaper stocks, pain in one bucket, funds accumulation in another bucket. That is an incredibly powerful structural advantage. It changes your emotional relationship to the whole event. And once you have experienced that shift, you stop seeing hedges as dead money and start seeing them as psychological and financial insurance with offensive optionality attached. Now, I do not want to romanticize this trade. The file itself admits the obvious risk, and I want to say it more plainly. This is not risk-free. It is not even close. The largest threat is de-escalation. If flows normalize faster than feared, if military protection stabilizes passage, if some geopolitical bargain reduces the perceived danger, or if the market concludes the worst-case scenario was overestimated, oil can retrace violently. Commodities are not gentle on the way down. The same speed that makes them attractive on the way up can punish you on the way back. That is why position size matters. That is why ego matters. That is why this cannot be approached as a fantasy that only has one ending. This is the sixth mechanism, I call it, hedge discipline. A hedge only works if it remains a hedge. The moment you emotionally convert it into a lifestyle bet, a prophecy, or a total portfolio identity, you have changed the job. The purpose here is not to become a prophet of permanent oil scarcity. The purpose is to own exposure to an acute supply shock with the humility to admit that acute shocks can de-escalate, reroute, stall, or change character. That is the right way to own something like this calmly, with size that can hurt less if you are wrong, with clarity about why it is in the portfolio, with no illusion that every geopolitical thesis gets to unfold in a straight line. Now let us deal with another important issue. The source text raises if reopening the strait were as simple as flexing superior military power, the market would likely be calmer. But the world is not a clean board game. Choke points can be militarily challenged while still remaining economically messy. Insurance can stay high. Shippers can stay nervous. Infrastructure can get hit elsewhere. Regional producers can remain exposed. Even a technically open route can function below normal if the surrounding conditions stay dangerous enough. That matters because investors often imagine restoration in a binary way, open or closed, fixed or broken, peace or war. In reality, markets can remain stressed in prolonged middle zones where the route is not fully shut, not fully safe, and not fully normal either. Those are exactly the environments where price can remain stubbornly elevated. This is the seventh mechanism. I call it impaired normality. A system does not need to stop completely to create severe pricing problems. It only needs to operate far enough below trusted normal that participants change behavior. Fewer tankers, higher insurance, delayed routes, partial rerouting, infrastructure risk, slower scheduling, more hoarding, more nervous reserve use, more precautionary buying, all of that matters. Markets price not only the absence of flow, but the quality of the flow. A badly impaired normal can be almost as important as an outright shutdown when confidence evaporates. And confidence in logistics is one of those invisible things the market takes for granted until it breaks. Now, I want to say something else. The average investor often resists. Oil does not need to go to some insane number to do its job inside a portfolio. People get distracted by the drama of whether we see $130, $150, or $200. Fine, those numbers matter. And if the supply shock lasts, extreme price spikes are very possible because demand destruction at lower levels may still prove insufficient. But from a portfolio perspective, the hedge can already be successful well before any absolute top is reached. If the oil position appreciates enough to offset part of an equity drawdown, or even enough to preserve psychological control and create future buying power, then it already served its function. That is why I do not need perfection. I need utility. This is the eighth mechanism. I call it portfolio level success. There's another reason I prefer a hedge like this over simply reducing all risk mechanically. Selling your long-term holdings every time the world becomes unstable sounds prudent in theory. But in practice, it often becomes a habit of surrendering your best assets exactly when fear is loudest. I have no desire to build a portfolio that depends on my ability to make perfect macro exits and perfect macro re-entries. I do not trust that style. It asks too much of timing and too little of structure. A hedge asks something different. It lets me keep faith with my long-term holdings while still admitting that some shocks deserve respect. That distinction is very important. This is the ninth mechanism. I call it ownership continuity. A lot of investors destroy compounding because they keep interrupting the assets that were supposed to carry them for decades. They sell great businesses, broad market exposure, and productive hard assets every time a new fear appears. Then they sit in cash waiting for the all clear, which arrives only after prices have already adjusted. I would rather stay structurally long and use selected hedges to absorb the kinds of shocks that can turn temporary volatility into emotionally expensive damage. That is a much more stable philosophy. And there is something else worth naming. Oil shocks are not only about inflation and stock multiples. They are also about political response. High fuel prices make voters angry very quickly. Angry voters produce pressure. Pressure produces bad policy, rushed releases, emergency rhetoric, subsidy talk, export restrictions, jawboning, and all the improvisation governments reach for when the physical world stops cooperating. Markets hate improvisation because it means the normal pricing framework gets contaminated by political desperation. That is another reason this kind of setup can become more violent than people expect. It is not just the barrel count. It is the secondary behavior from everyone trying to manage the consequences. This is the 10th mechanism. I call it policy panic spillover. The moment energy stress gets severe enough, nobody stays in their lane. Governments intervene. Central banks get dragged into debates they do not want. Corporate hedging behavior changes. Consumers change spending patterns. Freight and input costs reset assumptions across industries. A pure oil trade becomes a broad confidence trade. That is why I think this situation deserves more seriousness than a casual commodity thesis. Once oil becomes the messenger of systemic stress, every asset class starts listening. And one final point before I close, the reason I like owning the hedge before the panic is visible is that liquidity is always most generous before everybody agrees there is a problem. Once the crowd finally accepts the shock, entries get worse, spreads widen, emotions intensify, and the clean portfolio work should have already been done. Preparation is almost always cheaper than reaction. That is as true in markets as it is in life. Investors lose their minds constantly because they judge every position in isolation. Did oil top exactly where I sold? Did I maximize every tick? Did I catch the full move? Those questions are ego questions. I am much more interested in the portfolio question. Did this position improve the whole structure under stress? Did it reduce drawdown? Did it preserve optionality? Did it let me think and act better while other parts of the market were getting hurt? If yes, then it worked. That is what I care about. And this is where I come back to the title idea itself. I am investing in oil to protect against the stock market crash is not a slogan about abandoning long-term investing. It is a statement about respecting the fact that severe energy shocks can create the exact kind of inflationary growth, squeezing environment that broad equity markets hate. It is a recognition that the world still runs on physical systems. And when one of those systems is damaged, the people who only own abstract optimism suddenly remember that barrels still matter. That is why I do not laugh at oil here. I respect it, not because it is modern, because it is foundational. Everything else eventually reports to physical energy. So here is where I come down. The current setup is not normal. One of the most important oil arteries in the world is severely constrained. Millions of barrels a day are disrupted in one form or another. Inventories are acting as a buffer, but buffers are not infinite and not perfectly usable. Prices rising not because the full shortage has already arrived, but because the market is trying to solve the shortage early through demand destruction. If that process intensifies, oil can go much higher. And if oil goes much higher, the rest of the market may not enjoy what comes with it. That is the point. I am not buying oil because I want to make a theatrical bet on a commodity. I am buying oil because if this shock deepens, oil may be one of the few things in the portfolio positioned to rise precisely when broad stocks become most vulnerable. That is rational, that is defensive. And if the world gets better faster than expected, I will gladly take the disappointment in oil if it means the rest of my assets breathe easier. That is what a hedge is supposed to feel like. Not a religion, a protection, a temporary ally, a way of making sure that when a real shock moves through the system, I am not standing there with a fully exposed portfolio and no asset designed to benefit from the exact danger I already saw coming. That is why I am in oil. Not because I worship it, because I respect what high oil prices can do to a fragile market, and I would rather be early with protection than late with regret.